So after my second week of trading options went pretty well, and I walked away with a greater than 50% win-loss ratio, and I was profitable, I went into the third week thinking I'd try things a little differently. I have lessons that I learned from my third week that will lead into what I'm going to do for my fourth week of trading options. So as I've been saying for the last couple of weeks, what I figured out was that I wasn't so good at being able to predict directionally which way my investments were going to go, but I was pretty good at predicting how far in either direction. For example, when you look at the history of a stock, you can see that after it reports earnings, it'll typically go a certain amount in one direction or other, a certain percentage. And then if you look over its past, you can see where its most extreme movements are. I was making sure that the trades that I put on were never in excess of those extreme movements. For example, if you're looking at Nvidia and sometimes it sells off 20% after earnings or goes up 20% after earnings, then your trade should never be more than 20%. If you make it so that you're shooting for something that's never happened before, like Meta a few weeks ago, sure, it'll pay off once in a while, but for the majority of the time, you'll just lose money. Optimally, what you'd really like to do is pick a move that it almost always does. So if you're talking about a stock like PepsiCo, which doesn't move very much after earnings, you'd want to put on a trade that captures profit if it moves 3% in either direction, because it is that low a mover. This week, I did 3 separate trades, one on DraftKings, one on Twilio, and one on Waste Management, all 3 of which I own in different portfolios. First up, we'll talk about DraftKings. When it comes to DraftKings, I bought the 39-38.50 put spreads, and then I bought the 48-49 call spreads. On a chart, it looks like this. The green line represents where the trade begins to become profitable, and the red line means that if it gets below that point or above that point, it is fully profitable. As you can see, what happened with DraftKings is it came out and reported earnings, and it missed, which originally caused a disappointment, but not enough to trigger the put spreads. The fervor behind this stock is so good that on Friday, people bought it up. So even though it gapped down when it opened, it actually finished the day above flat. So even though it disappointed on earnings, it actually ended up higher than it did the day before. But as you can see, it didn't go high enough to trigger my call spreads, which meant this entire trade expired worthless. It was a total loss. A couple of the key lessons I learned was to not buy the spreads too early. I bought the put spreads back on February 6th, the first week that I started trading, and realized almost immediately when I bought them that I probably overpaid because DraftKings ended up rallying into earnings. If I had waited until we were closer to earnings, not only would I have been able to buy put spreads that might have captured that downside move, they would have actually been cheaper because I was paying premium for the length of the spread. The further out from expiration, the more those options will cost. You'll notice that I made another mistake this week, and I did it in a couple of trades. I bought the put spreads that had a 50-cent spread, but I bought the call spreads that had a $1 spread. What this means is that if DraftKings had rallied up, I could have made as much as $100 on the trade. But if DraftKings sold off, the most I could make was $50. This is okay if you want to make a bullish bet and hedge against it, but that's not what I was trying to do here. What I'm trying to do is called a straddle. I want to profit regardless of which direction the stock moves. Because of this, I need to make sure that the distance between my strike prices is the same for both the calls and the puts. That way, if the stock rallies, I can make the same potential profit as if it sells off, as opposed to having a trade that's lopsided like this, where I could make less money if it sold off than I did if it rallied. Now, of course, with DraftKings, that didn't matter since the whole trade expired worthless, but this will actually take effect later in one of my other trades. Next up, I bought Twilio's 63-62.50 put spreads and Twilio's $76-77 call spreads. You can see the exact same thing that I did with DraftKings. This isn't a straddle, this is a bullish trade with a hedge, and it goes against what I was trying to do. And in Twilio's case, it went the other direction. Twilio ended up missing on earnings and sold off substantially. We're going to watch the price action using the 5-minute candles on Twilio's chart. And we'll start right where it was at the end of day on Wednesday, right before it reported earnings. As you can see, the immediate response to earnings was pretty dramatic. And as we moved through the following 2 days, you can see where there were points where the trade actually became profitable to the downside. Here and here. As you can see that both of these candles had dropped below the green candle, which meant that the trade was profitable. And this candle actually went so far down that it made the trade fully profitable. However, since this happened on Thursday, that means it's not going to be fully profitable because there's still time left. It doesn't expire until the end of day on Friday. I did decide to let Twilio play out to see where the price action would take us. And as you can see, as we move through Thursday into Friday, not only did Twilio continue to sell off, it did it to such an extent that it would have made my trade fully profitable. When we zoom out on the chart, you can see where it closed on Friday was far below the 62.50 spread. However, I don't want to wait too close to the end of the day because you never know what's going to happen. There could always be a positive reversal. So when the trade got pretty close to being profitable, I closed it. I ended up selling the put spreads for $44.92. And this is pretty good because the most I could have sold them for was $49.92. I captured 90% of the potential profit in this trade. However, just like with DraftKings, because the spread was tighter on the put spreads, I barely broke even on this trade. The total trade, the combination of both the calls and the puts, cost me a total of $44.16, and I did sell it for $44.92. Now this means I made a profit of 1.7%, but when you're talking about options, that just basically is breaking even. This was a successful trade because I accurately predicted how far Twilio could move in either direction. But the problem was I bought the 50-cent spreads on the puts, and I didn't make as much money as I could have. Additionally, in this particular case, the calls cost quite a bit at $29.08, whereas the puts only cost $15.08. What I should have done was to make sure I reduced the cost of the calls. In fact, from here on out, I've decided if I can't make these trades for $35 or less, I'm just not going to try them. I need to get much better at my win-loss ratio before I start to ramp up cost. For my third trade last week, I did waste management, and I bought the 175, 172.50 put spreads, along with the 200, 202.50 call spreads. Now, for waste management, this would have been a pretty extreme move in either direction. But waste management had rallied significantly going into earnings. As you can see on the chart, waste management was near its all-time high. And I felt like it would have had to dramatically surprise for it to be able to do anything to the upside. But if it did, I felt like it might move quite a bit. Additionally, toward the downside, I felt like because it had rallied so much into earnings, if they disappointed, it would have been a substantial disappointment, causing it to sell off probably to this next level of support. So let's switch to the 5-minute candles and see what happened after Waste Management reported earnings. You can see that initially before the conference call, Waste Management did pull back a little bit. But then you can also see that after the conference call, things got really good for the company. On Tuesday, the day after earnings, Waste Management was bouncing around the high 190s, and I didn't think it would possibly be able to get all the way up over my call spreads. However, if I had waited until the end of the week, Waste Management ended up breaking through the $200 barrier and got all the way to printing the entire call spread, as you can see, during the day on Friday. However, because it spent so many days underneath the $200 mark, which means it was underneath that first spread that would have had to jump over for these to become profitable, I decided to sell the trade early. In this case, you can see what happens when there's momentum behind a trade. Even though the stock price of Waste Management didn't exceed $200, the call spread that I owned on the upside, because the momentum was there pushing the stock price up, my call spread increased dramatically in value. In fact, I was able to sell the call spread on Tuesday for $50.92. The entire trade cost me $43.16, which means I made a profit of 17.98% on this trade, and that was selling it before they had actually printed. In this particular case, I wasn't confident enough about the price momentum in Waste Management to take it over $200. $200 in round numbers like that tend to be a psychological resistance area. In other words, many investors will take profits or try to short a stock when it reaches a key area like that. It's not significant mathematically, but round numbers are real when it comes to human psychology. So yes, if I had waited, chances are I could have gotten a lot more money out of this trade. The spread was $2.50, which means I could have sold it for a maximum of $250 instead of selling it for $50.92. but I still did make a profit, so this was a successful trade. Overall, I did have a good win-loss ratio this week. I ended up doing a total of 3 trades. I won 2 of them because Twilio did come off with a gain, which gives me a 66.67% win-loss ratio for the week. Overall, looking at all the trades that I have done, I now have brought my win-loss ratio from 12.5% up to 38.89%. For me to have a lot of confidence that I'm able to do these trades right, I really need that win-loss ratio closer to 50%. In fact, I'd prefer for it to be over 50%, even though that's a lot to ask for a new trader. So what did I do right this week? I only made 3 trades, but that was out of a potential 7. One of the trades that I passed on was Barrick Gold, and you can see why. It ended up selling off significantly with the price of gold into earnings. I felt like even if Barrick ended up reporting a good earnings report, because gold was under so much weakness, the upside that it would be able to rally to would be limited. Additionally, because Barrick Gold was so oversold into earnings, I was concerned that even if it disappointed, there wasn't a whole lot more downside that it would have before it bounced. And you can see that's kind of what happened. Barrick Gold reported earnings before the bell on Wednesday, and you can see it only pulled back 2.76%. because it ended up actually having a surprise upside. However, because the underlying asset, gold, was so weak, you can see that even though it reported good earnings, it only rallied a maximum of 5.05% and finished the week up 4.2% from where it had reported earnings. Neither of these would have been a really good percentage move, so my instincts were correct. I was looking at making a trade on Coinbase, but the problem with that one was the options in both directions were incredibly expensive. After Coinbase reported earnings, it did end up rallying to a high of 40% higher than where it closed the day before earnings, which would have been great for anyone who bought call options. But like I said, I was mitigating my risk by reducing the amount of money that I was going to put on in the trade, and Coinbase was going to be a very expensive trade in both directions if I tried it. If it ended up reporting and pulling something like DraftKings did where it remained flat, that would have just been a total loss. So it was good that I passed on that trade too. The third trade that I was looking at was Digital Realty Trust, but the options again were too expensive. And it's a good thing I didn't get in because as you can see, it rallied 4% the day before it reported earnings and then ended up crashing down a total of 8.34% after earnings. Neither of those moves would have been 10% or more, which was what I was looking at for Digital Realty because the options were so expensive. As a result, this trade would have expired worthless too. This is also a good example of something that I'm going to look at in the future. If I've got a stock that's reporting earnings on a Thursday or a Friday, I think I'll buy the options that expire the next week out. As we saw with Twilio, sometimes after a negative earnings report or a positive earnings report, the stock can really sell off for a few days afterwards. But if you buy options that expire on the Friday and the stock reports earnings Thursday night, that only gives you 1 day of movement. That might not be enough, just like it was with Twilio. So it did end up closing below the put spreads on Thursday, but look at how much lower it got on Friday. In fact, I think as we head into the next week, Twilio might continue to sell off, which would have enabled me to be able to buy even lower put spreads with 1 week more expiration. Waste Management was a little different because it reported earnings after the bell on Monday, which gave it 4 full days to be able to move higher. And as you can see, that momentum led it to be able to print the options that I bought. So once again, if the stock reports earnings on Thursday or Friday, from now on, I'll be buying options that expire the week later so that it gives it more time to move if there is significant momentum behind the report. So what did I get wrong this week? Well, the first big one is costs. Whether it was the DraftKings trade where the call options cost me $30, the Twilio trade where the call options cost me $29, or Waste Management at $25, I was spending too much money. The idea of these trades is to take a really small amount of money, bet on a more extreme move, and then have the option print a multiple of whatever it costs. However, by buying the more expensive spreads, that means I need to make sure I can cover the costs in both directions. This leads me to my second mistake that I made, which was buying bullish moves. I was buying options where if the stock rallied, I would have been able to sell them for $100, but if the stock sold off, I'd only be able to sell them for $50. And when you're looking at trades that were costing $44 to put on, that's a very slim margin on the downside. So next week, I'll be looking at being much more careful with the cost of the trades and the spreads, making sure that I mirror whatever I do to the upside also to the downside. And I'm also going to be trying to get tighter strikes so that I don't have to have the stock move so much. Additionally, next week will be Nvidia's earnings. And because it is the biggest position in my investments in play portfolio, I will be buying put spreads, not call spreads. I'll be covered to the upside by that giant position, but I want to buy put spreads in case Nvidia misses on earnings. It's going to be interesting because many of the pundits believe that whichever way Nvidia goes, it will take the market with it. However, expectations going into earnings for Nvidia couldn't be higher. It's possible that it could beat on expectations and still sell off because it can't beat the expectations the street has. Now, it's always possible Nvidia will just exceed everything and rally afterwards, but I have a feeling this is going to be a very exciting week, so stay tuned.